What is going on, investors? Hopefully you guys are doing well out there. Time to talk about Fiverr International, ticker symbol FVRR. Look, if you've been in this stock for a while, you are up massive. This stock is up over the last year 121%, but we saw after reporting Q2 earnings today, Fiverr stock got obliterated, down 24% in one day. Look, this is actually not that uncommon in penny stocks, microcap companies. This is a big market cap company of over $8.7 billion market cap. To lose a quarter of your value in one day is actually a pretty big deal, and that's part of the reason why we're covering Fiverr here on today's show. We will get into the numbers, but as you can imagine, when a stock goes down 25% in one day, it really creates a lot of impact from a technical perspective as well. We'll talk about that towards the end of the video, but this stock was up over $330 per share, and now we're closer to $177, about a 50% decline on Fiverr shares just really over the last couple months. So you might be asking yourself, what is going on with Fiverr? Maybe you want to buy the dip, okay? When you see these 25% declines in the stock, you might be asking yourself, is this a buy the dip opportunity in Fiverr? We'll talk about that. The other thing we'll talk about is why this stock dropped 25%. Maybe you own this at a higher price and you're wondering what the heck happened. We'll talk about that on today's show. We'll answer all those questions for you here on today's show. Now, what I also want to talk about is some of you might have came to Fiverr. I can imagine a lot of investors kind of came to Fiverr because it's a website that you used, and I'm in that boat as well. Look, I remember using Fiverr back when everything on the site was actually $5. Now, when you use the site, almost nothing is $5, or at least, from a certain perspective. And so I actually think the value proposition was better on Fiverr years ago when everybody was competing at the same price point, driving up the value of that $5 service. Now people are charging $50, $100, $200 on the site. And obviously that's better for Fiverr, the company. But I think from a user perspective, the value proposition has slipped a little bit with Fiverr. But the one point that I want to make before we get into the guidance, before we get into these numbers as well, is the point that I want to make is some of you might say, because I've used Fiverr, I've bought and sold on Fiverr. Believe me, it's a site that I've used for a very long time now. I can't even remember when I first signed up for it. It was a long time ago. You might say, well, I'm a Fiverr fanboy. I'm going to get in here and buy the stock. That is first grade stock analysis. Okay, what do they tell you when you first get into investing? Invest in companies, and in this case, maybe a website that you know. Okay, if I was to advise my 4-year-old or advise a 7th, 8th, 9th grader into beginning stock investing, I'd say, hey, pick out some stocks you know, maybe a Disney, a Nintendo, a Sony, Microsoft for Xbox, Nike, those types of things, companies that you know, you wear, you touch. That is investing 101. That is kindergarten. This is not the kindergarten investor channel. This is the investor channel. I'm here to make you a better investor. I'm here to make you the best investor. And you don't do that by just simply investing in stocks you know. So while I know Fiverr, I like Fiverr, doesn't mean I'm going to not look at these numbers and pick them apart if they need to be picked apart. So let's talk about this. In the quarter, the guidance came in. So we'll talk about the Q2 numbers here in a second. Okay, we got our Q2 numbers here for the last 3 months, $75 million worth of revenue, but we're sitting here in August. These numbers ended in June. Fiverr has visibility a month into a 3-month quarter, the upcoming Q3, right? Because we're already past July, that's past June, and we're a little bit into August. They have more than a third insight into the sales that are going to come in for Q3. So they're giving guidance for Q3, which is the upcoming quarter. That guidance came in, and this is on the revenue side, between $68 and $72 million. This is for Q3. Oh, wait a second. We just did a quarter where we did $75 million worth of we just did $75 million worth of revenue. And now this company is saying that Q3 is going to come in under that. Okay, that is a big reason why this stock has declined and declined rapidly. Investors do not want to see quarter over quarter growth, especially that big. And look where consensus was. Okay, this was the consensus of analysts on the street. And Fiverr hasn't been around a long time. They're probably not as well covered, obviously, as some mega cap companies, but they've got enough competent analysts out there to recognize that they were expecting $80 million worth of revenue. And that makes more sense, right? You go from 75 million in revenue in this quarter, next quarter you bolt on 80. But no, Fiverr is saying, nope, we're going to come in between 68 and 72, which is a decline quarter over quarter. That's a problem. Full year revenue, again, we've got 4 or 5 months left in the year that Fiverr has visibility into. You're coming between $280 and $288 million worth of revenue. That's basically showing you we're going to come in flat, because here's for the last 6 months. You times this number by 2 and you're getting between 280 and 286 per revenue. So they're just showing you the next couple quarters are really just going to be kind of flat from a growth perspective, quarter over quarter. That is a problem. And management blamed it on a shift away from online, but I just did videos on Facebook and Google, and Amazon might have had a little bit of that evidence there, but not a lot. I'm not buying what Fiverr International Management is claiming is what's happening with this company, and I don't think investors are either, because the stock is down 25% today alone. Now, we've got our 3 months ended here. Now, look, the guidance was bad, but I do not think that is what is the major cause of the downtrend. Okay, is it part of it? Yes. But let's take a look at these numbers, because I think you're going to find some of this interesting as well. So we got our revenue here on the top line. Right-hand column here is last year on a quarterly basis. On these 2 right-hand columns over here, we're doing it on a 6-month basis. We'll focus on the most recent quarter. We went from $47 million worth of revenue up to $75 million worth of revenue. Solid growth, obviously. Take a look at the cost of revenue. It only went from $8 million up to $12.5 million. Oh my, high margins. I love what I'm seeing here. Our gross profit off of $75.2 million worth of revenue, this company's gross profit is $62.7 million. That is fantastic. So not only check the high gross profits, high gross margins once, check it like 3 or 4 times, because Fiverr is checking all the boxes up here. Looking absolutely fantastic. This is what investors absolutely love. And I would say for the most part, this is why this stock rallied from like a $30 stock to over 300, because investors were looking at these really, really high gross margins. Now, here's our operating expenses: R&D, selling and marketing, and general administrative. Take a look at this. Research and development. We'll talk about marketing here in a second. Actually doubled from 10.5 to 20.1. Selling and marketing didn't quite double, but it did increase, as you'd expect with revenues going up like this. I'm actually surprised selling and marketing didn't go up even more. It went from 23 million up to 38 million. Take a look at general administrative. This is probably where you had a lot of leakage, because these doubled as well, more than doubled. You went from 6 million up to $12.8 million. Take a look at our total operating expenses. Went from 39.7 million up to $71 million. So I want to focus on last year's quarter. We had $39 million in cost, and we had $47 million worth of revenue, right? So that's about an $8 million delta. You'd like to see it a little wider than that. But take a look at what happened in the most recent quarter. Okay, we had $71 million in costs, and we had $75 million worth of revenue. That's only a $4 million delta. So it's showing you that these expenses down here, the R&D, selling and marketing, and particularly general administrative as well, are growing a little bit faster than our revenues are growing, and that's a problem, especially when you combo that with Q3 guidance, which is showing you that we're going to have contraction in our revenue growth quarter over quarter. Our revenue growth is going to go flat for the next 2 quarters. In fact, that's exactly what management over at Fiverr is telling you. They're telling you we're going to come in at 280 for the next 6 months. That's basically identical to what we just did. And I think investors are connecting the dots. They're saying, well, wait, R&D is probably going to go up. Selling and marketing is probably going to go up, and general administrative is probably going to go up. So what's going to happen to our operating loss? It's only going to get bigger and bigger. Take a look at last year. Again, I talked about we were on a little bit better footing. We were at $600,000, basically break even. I mean, this is like, yeah, $600,000 is a lot of money, but $39 million of operating expenses, it's basically a rounding error. Well, now we got way more than a rounding error. Our operating loss is now $8.3 million. You might say, well, that's not that much. Okay, but wait a second. This is an $8.8 billion, and not million, $8.8 billion company. and they've just increased their operating loss. It looked like they were on the tipping point of profitability this time last year, and they've gone through a great year where a lot of people needed these services online, and they've expanded that operating loss. On top of that, they're guiding for Q3 and Q4 to basically be flat or identical quarters from a revenue perspective. And we as investors have to assume cost of revenue is probably still going to go up. All these other costs are going to go up. So the profitability is going to get even worse over the next 2 quarters. I think that has investors very, very concerned. Now, from a cash flow perspective, paints a little bit better story, but you got stock-based compensation. Take a look. You pull down this net loss of $13.3 million. This is for 3 months. You get to add back in $13.1 million worth of stock-based compensation. Wouldn't you love to be able to write that off on your cash flow statements and sell to investors? Look, we had positive cash flow of $15.5 million. No, you didn't. Okay, you would have had to pay these, and the more this stock goes down, look, it's going to be harder and harder to convince employees to come work for you for the stock if it goes down. So I don't really buy that a whole lot. All things else being considered, not a lot going on here from a cash flow perspective. As you can imagine, as a pretty young company, a company with high gross margins, a company that, while it's not profitable, I think other investors are starting to connect the dots here. We got bank deposits, user funds. This is an asset, but they couldn't run off with those. We got marketable securities and cash equivalents. This looks like to me about $400 million worth of cash. We're not going to count these user funds here. And not a lot of liabilities, total liabilities coming in at 550. So there's not a lot here, but I think investors are saying, well, in the last 6 months, we burned through $31 million. The company is likely, in all likelihood, unless they somehow magically grow revenues and contract or keep expenses where there are, which I doubt they're going to be able to do, well, they're going to lose another $30 million, maybe even more, maybe 40, 50 million over the next 6 months. All of a sudden, the cash on the balance sheet doesn't look that good. How are they going to raise the money? Well, they're going to sell shares of Fiverr, which they have done over the last year or so. We had 33 million shares outstanding. Now we got 36 million. I would expect them to continue to have to raise money, because if these types of results continue, I don't want to say this company is going to be in trouble from a financial perspective, but they don't have a lot of assets on this balance sheet, okay? This is not a lot of cash, $400 million. Again, I'm not counting these user funds here, and you could actually take away these user accounts probably from the liability. This is probably just balancing each other out for the most part. So from a liability perspective, there's not a lot here, okay? But if you're burning through cash on a quarterly, 6-month, yearly basis, you're going to need more cash than this at some point, or investors are going to become slightly concerned, especially if you hit a really rough patch over at Fiverr. You have to invest a lot of money, marketing, sales, research and development, whatever it is. Well, yeah, things are going to get even worse. Now, speaking of getting worse, this stock was up over 300 and something bucks. This was back in February. We're not talking about like last year or like not that low, like a long time ago. We're talking about back in February. In fact, the middle of February, this thing was up over 300 and some odd dollars. Even yesterday, yesterday, we were at $230 on this stock. Now we're all the way down here at 177. From a technical perspective, absolutely, we pulled into a range. Because take a look, this stock was like, it IPO'd at like, I don't know, like $30 a share, rallied hard. It really got its feet right here at 160, chopped here at 160, and then when it broke above 190 for the first time, it went from 190 to 330 in very, very short order. We're talking about just a couple of months, and then it came all the way back down here, and where did it find support? Right where it first launched off, right here at 160. Came back up here. This is more of a technical fake out, I think. I still think what we're in here is in a downtrend, okay? And it's a sloppy downtrend, but it is in a downtrend. Obviously, when you drop off 25%, it just blows your ability to kind of look at this from a technical perspective on a longer term view. But from a broad perspective, we are in a zone here from 160 to 190 where buyers have stepped in on this stock. Take a look. I mean, this stock chart goes back to October when this stock has been in this 160 to 190 range. It has not hung out here long at all, okay? In fact, buyers show up and they show up in force, And once we break back above 190, well, technically this stock has a lot of room to run. And there's really a double, kind of two things that are going to pull this stock upwards, in my opinion, at some point. You get back above 190, well, you're going to fill this gap, okay? What stocks like to do is when they create these big gaps, they like to walk back up and fill these gaps. So a break above 190 will be an incredibly bullish, on 2 candles, 3 candles, will be in bullish. I think you can go from 190 back up to 220, 230 on this one in pretty short order. So from a technical perspective, there's some things to like here. Now that I'm not guaranteeing, I just gave you like the bull case technical, analysis. Okay. This thing is down 25% in one day. We are in a downtrend. Okay. We broke this. We were in an uptrend. We broke it. We were trying to do kind of a fake out uptrend. We broke that too. Look, if you break 159 on this one, if you for some reason think you're going to buy Fiverr stock and you want to buy it, I would set a stop loss right here at 150, okay? If you buy it here at 160, I'd put a stop loss at 150, because if you break 150, the odds of this thing going lower and much lower increase rapidly, okay? And so from a technical perspective, I like this one way or another, okay? There is absolutely some opportunities here. I'd put this on your watch list, especially if you kind of trade stocks. From a buy and hold perspective, I don't necessarily see a lot here. They're going to have to raise some cash. They're going to have to do that likely through the equity markets. They're going to have to put out more shares. That means you're going to be diluted. That's going to make EPS look even worse as we go forward. They're not projecting higher revenue growth. That's a problem. I think the only thing I really, really like in these financial statements is we have high gross profit. And if I only looked at gross profit, there'd be like 1 million stocks I could invest in. Stocks have to check lots of boxes, okay? And the first box I look for is revenue growth. We check that box. High gross margins. We check that box. But then scalability of that, okay? Yes, we have our revenues growing. Yes, we have high gross profit. But can we scale that by not blowing a bunch of money on these other operating expenses? And Fiverr is not proving that. They're not proving that these other expenses have reached scale and started to level out. In fact, they're increasing, and they're increasing rapidly, like over 100% year over year. On top of that, the company is coming in with absolutely dismal guidance, which shocked investors, which shows a little immaturity from management. They've got some lessons to learn as well. I personally think if you like this one from a fundamental perspective, just let it breathe for a while. This is still a super young company from a market cap perspective, a valuation perspective. This thing is way overvalued. 586 times forward P. 586 million forward P would be unbelievable. $8.78 billion valuation on a company that's guiding to flat quarter over quarter revenue for the rest of the year. That is not good. That is not what you want to see from a technical perspective. Are we pulling into zones? Absolutely. I would tread lightly with this one. If you trade this one, you absolutely need stop losses, and you absolutely need to hit trailing stops or predict yourself on the way out here. I personally wouldn't touch this one in this range. I'd actually play the breakout above 190. That's what I'd like to play on this one. You get above 190, even really 200 on this one. I think you can play this one from 200 all the way back up here to 230. Okay, so you got a nice little $30 share price run on this one. You put a $5 or $6 stop loss, maybe back down here at 191, 190. You risk a little bit of money. You can make a little bit of money. That's what I see on Fiverr. Hopefully you guys learned some things from this video. We'll be back again soon with more all this week and next. Good luck with your investments.